Hi there traders. In today's video we're going to be looking at how distribution days can foreshadow a correction. So there are a number of techniques that investors can use to determine the sentiment of the broader market. Sentiment is a measure of investor confidence in a market. Positive sentiment is associated with increasing prices, where negative sentiment is correlated to decreasing prices. The combination of price action and volume helps measure sentiment and can be used to predict direction. One of the most interesting ways to measure negative market sentiment is to define distribution periods. Distribution days are a sign that the big players in the market are starting to take profits and unwind their positions. This can be measured by using a combination of price movements and volume. By measuring distribution, a retail investor can avoid a situation where large players are selling stock to smaller players who are just entering the market. Once the big institutions start to leave the market, retail investors are sometimes left holding the bag. According to Investors Business Daily, a distribution day is defined as the loss of more than 0.2% by a major index, while volume ticks higher than the prior session's total. Tracking the accumulated damage is crucial to gauging a market's health. Institutions are the heavyweights that largely determine the market's direction. They account for perhaps 75% of daily trading. In a nutshell, when they buy or accumulate stocks, the market goes up. When they start to sell, the market falls. When a market is edging higher while distribution is taking place, a retail investor should be aware that the resistance taking place will likely turn into a market liquidation when the last buyers have purchased a stock. Investors can use distribution days to give them a warning sign that a market is turning. For example, when a security or index experiences 3 distribution days in a row, an investor can determine that the security or index is experiencing negative momentum. You can see an example here on the chart where we've got a few down days and increasing volume compared to the prior day's session. So we've got 4 distribution days here in a short space of time. Can indicate that the market is beginning to top out. IBD counts distribution days, but not in consecutive order. They've determined that 6 to 7 over the course of a month reflect a warning sign to investors that a market is vulnerable. Multiple distribution days do not necessarily mean a market is going to move lower. According to IBD, there are a number of ways distribution day count can be terminated. The first way a distribution day is terminated, according to IBD, is by the calendar or the passage of time. After 25 trading sessions, a distribution day expires. The count of distribution days reverts back to 0. A second way a distribution count can terminate is for the index to rise 6% on an intraday basis from its close on the higher volume loss day. The third way is far more painful. A broad market correction makes the distribution day count a moot point. Often, a high distribution day count will foreshadow a correction. Distribution is a sign of market sentiment and can be a useful tool to help an investor exit positions or hedge in case an impending correction is imminent. So I hope you enjoyed this short video. If you did, just make sure you give it a thumbs up. Also, make sure to check out optionstradingiq.com. You can check out a little bit more about how I trade, and lots of free courses and things that you can take there. Some really good stuff there. So hope to see you. Feel free to email me anytime, info@optionstradingiq, and I'll talk to you soon. Cheers, guys.